If you want to understand how professional traders trade fast-moving markets, you need more than random entries and emotional reactions. In this video, we are going to break down 5 scalping strategies professionals use to read liquidity, supply and demand, order blocks, fair value gaps, and price action with more structure and confidence. You will learn how these 5 models connect to real market mechanics, from liquidity grabs and draw on liquidity, to supply and demand trading strategy, order block trading strategy, market structure shifts, and inverse fair value gaps. By the end, you will have a clearer roadmap for choosing the right scalping model instead of forcing trades every time the market starts moving. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. We will begin with the first trading model. This strategy is built around 3 core components. These are a draw on liquidity, a liquidity grab, and the entry itself. For this setup, 2 timeframes are used to execute the trade. On the higher timeframe, key liquidity levels are identified and a clear draw on liquidity is defined. From there, we move down to the lower timeframe. At that level, the goal is to spot a liquidity grab that aligns with the direction of the draw on liquidity. Once that occurs, the trade is executed, and both the target and stop loss are set accordingly. Before moving to the charts, it is important to note that this trading plan is not restricted to a single time frame. That said, the entry time frame should always be 2 time frames lower than the higher time frame. Based on your trading style, there are 3 time frame combinations you can apply. As an example, when using the 4-hour chart as your higher time frame, the 15-minute chart should be used for trade execution. Now, I will walk you through how this looks directly on the price chart. The first step is to identify a draw on liquidity on the higher time frame. But what does a draw on liquidity actually mean? In simple terms, it refers to recognizing a key liquidity level that price is actively moving toward. More often than not, the market is drawn to areas where liquidity is resting, such as equal highs, equal lows, or strong reversal points, because these zones contain a concentration of stop losses and pending orders waiting to be executed. These liquidity levels should always be marked manually on the chart. In this tutorial, the focus is on reading raw price action and applying smart money concepts without the use of indicators. By marking these areas yourself, you gain a clearer understanding of how liquidity forms and how price behaves around it. The next step is to zoom into a lower time frame and look for a liquidity grab that aligns with the direction of the draw on liquidity. With that in mind, let us move down to the lower time frame. Keep in mind that buy-side liquidity is positioned above current price. With that context, the objective now is to see a swing low taken out. In other words, we are looking for a bullish liquidity grab which suggests a potential continuation to the upside. On the chart, this type of liquidity grab is identified directly through price behavior. A bearish liquidity grab occurs when price trades above a previous high but quickly falls back inside the range. This shows that buyers failed to hold higher prices, and that price was immediately rejected, pointing to bearish momentum. After this kind of move, a stronger push to the downside is often expected. In contrast, a bullish liquidity grab forms when price trades below a previous low and then rapidly returns back inside the range. This indicates that sellers were unable to sustain lower prices and that the market rejected that downside move, signaling bullish momentum. Once a bullish liquidity grab has been identified, the trade can be entered as soon as price returns inside the range. A more conservative option is to wait for price to continue moving higher to confirm the reversal, and then look for fair value gap formations to place a buy limit. If no clear fair value gaps are visible on the 5-minute chart, dropping down to the 1-minute chart can provide additional precision. Now, let us begin with a brief recap of the bearish setup. In a bearish scenario, the first task is to identify a key liquidity area that price is moving toward. This may be a previous low or a level where a large number of stop losses are clustered. These zones tend to draw price in before a reversal takes place. Once that area is defined, move down to the 5-minute chart. At this stage, wait for price to push above a recent swing high and then quickly return back down. This behavior indicates that liquidity has been taken and that the market may be preparing to move lower. After this confirmation, enter a short position and place your stop loss above the high created by the liquidity grab. Allow enough room for price to fluctuate and avoid placing the stop too tight. For your target, focus on the next clear sell-side liquidity level. This approach keeps the trade structured and intentional. Now that we have seen how liquidity grabs can be used to enter trades around key liquidity targets, let's explore another popular approach used by professional traders. Instead of focusing primarily on liquidity, this next strategy is built around supply and demand zones and trend structure. Now, inside the supply and demand framework, we can use two different approaches. The first uses a single time frame, while the second combines higher time frame zones with lower time frame confirmation. Let us start with the single time frame supply and demand entry. This approach follows a clear and simple sequence of steps. It can be applied to any market and on any time frame. The first step is always to identify the overall market direction, because trading in alignment with the trend increases probability. So let us begin with a quick and practical way to determine that direction. When price creates a clear 1, 2, 3 pattern and then breaks out, that structure defines a trend. If price continues by breaking above the most recent swing high, it confirms continuation. As long as price remains above the latest protected swing low, the market stays in an uptrend and our bias remains bullish. If another breakout occurs to the upside, we then mark the lowest point that led to that breakout as the new protected swing low. And again, as long as price respects that level, we continue looking for buying opportunities. However, if price breaks and closes below the protected swing low, that signals a change of character. In simple terms, buyers failed to maintain control of the structure, and sellers are beginning to take over. That shift suggests a potential reversal. From that point forward, we can shift our focus to identifying fresh supply zones and preparing for possible short positions. Once direction is clear, step 2 is to mark supply or demand zones according to the rules we covered earlier. In this example, the market direction is bullish, so we focus only on demand zones and buy setups. Mark the most recent valid demand zone, place a buy limit at the beginning of that zone, and position your stop loss below it. If the stop is also below the protected swing low, that is even better, as it typically provides stronger structural protection. For take profit, aim for the next significant level in front of price. But before finalizing the trade, pause and evaluate one critical factor. How much room does price actually have before reaching the next key level on the higher time frame? For example, in this scenario, imagine we zoom out to a higher time frame and notice that price still has significant space before reaching the next major level. In that case, entering the trade makes logical sense because there is room for price to move. Now consider the opposite situation. If price has just tapped into a strong, higher time frame resistance area with clear reversal potential, taking a buy trade becomes much riskier. In that environment, it is usually wiser to wait for confirmation or shift your focus to possible selling opportunities instead of forcing a long position. Before we refine this model, notice that this approach is intentionally simple. It relies on a single time frame, clear trend identification, and well-defined supply and demand zones. However, many professional traders prefer adding an extra layer of confirmation before entering a position. One of the most effective ways to do that is by combining higher time frame zones with lower time frame price action. Let us see how that works. We follow the exact same principles we discussed earlier. The only difference is that we refine our execution by dropping down to a lower time frame for confirmation and entry. This approach can be applied to any market and does not depend on a specific time frame. The key rule is simple. Your execution time frame should be roughly 2 steps lower than your higher time frame. Here are a few practical combinations based on trading style. For instance, if your higher time frame is the 4-hour chart, you can drop down to the 15-minute chart for execution. Now, let me walk you through how this works in practice. The first step is to identify the overall trend and mark the relevant supply and demand zones on your chart. At the same time, analyze the higher time frame structure to measure how much room price has before reaching the next key level. This helps you avoid entering trades with limited potential. Next, be patient and wait for price to retrace into your selected zone. Do not enter prematurely. The market frequently sweeps early entries and uses them as liquidity before making the real move. So the rule is simple. Let price reach your demand or supply zone first. Once price taps into the supply zone, shift to the lower time frame to look for confirmation before entering a short position. On this lower time frame, you may notice a clear uptrend, which represents the corrective move within the higher time frame structure. What we want to observe is a loss of strength inside the supply zone. In practical terms, we look for signs of rejection or evidence that the lower time frame uptrend is beginning to weaken. There are several valid triggers you can use for confirmation, such as a strong wick rejection, a break of a trend line, or even a change of character. In this particular example, however, we are looking for a liquidity grab inside the supply zone. A bearish liquidity grab happens when price briefly breaks above a previous high, but quickly returns back into the range. This tells us that buyers failed to sustain the breakout, and the move was likely a trap. At the same time, liquidity resting above the swing high has been swept. After this type of behavior, the probability often shifts toward a stronger move to the downside. In the same way, a bullish liquidity grab forms when price breaks below a previous low, but quickly moves back inside the range. This behavior shows that sellers were unable to sustain the move lower, and the market immediately rejects those lower prices. As a result, liquidity resting below the swing low is taken, and momentum begins to shift in favor of buyers. When this sweep happens inside a higher time frame demand zone, the probability of a stronger move to the upside increases. Both bearish and bullish liquidity sweeps tend to be more reliable when they occur within higher time frame supply or demand zones. That higher time frame context adds weight to the setup and filters out weaker signals. So how do we execute the trade using this approach? Start by drawing a line from the tip of the wick at the most recent swing point. If price pushes beyond that level, takes the liquidity, and then closes back inside the range, that close becomes your confirmation. At that moment, you can enter the short position, place your stop loss above the swing high, and aim for the next significant level ahead of price as your target. And above all, remember that context and patience matter. Focus only on high-quality setups, control your risk carefully, and never force a trade. When you apply these principles consistently, supply and demand trading can become a structured and reliable part of your overall strategy. So far, we have explored how supply and demand zones can be traded using both single and multi-timeframe approaches. However, there is another powerful way to combine higher timeframe zones with lower timeframe confirmation. Instead of relying primarily on liquidity grabs, this next model uses market structure shifts and breaker blocks to identify high-probability entries within key supply and demand areas. This setup also works with two timeframes, the 1-hour and the 5-minute charts. On the higher timeframe, we analyze the overall market condition. At this stage, we are looking for unmitigated high-quality supply and demand zones. From there, we zoom into the lower timeframe to follow the higher timeframe delivery and look for reversal or confirmation signals. This is the stage where your entry model needs to appear before you open a position. Now, let's go step by step on the chart and see exactly how to apply it in a bullish scenario. To begin, confirm that price is in an uptrend and that buyers are in control of the market. To do that, you need to identify at least 2 consecutive bullish breaks of structure. Start by marking the structure manually on the chart. Once price forms 2 consecutive bullish breaks of structure, shift your focus to the most recent one. From there, trace back to the origin of the bullish expansion move, the move that caused the break. That origin point is what defines the demand zone. The next step is to mark the most recent unmitigated demand zone on the higher time frame. After that, wait for price to return to that area. Once price taps back into the zone, move down to the 5-minute chart and closely observe the price action for signs of a reversal. This will act as your first confirmation before you begin looking for an entry. That confirmation can come in the form of a market structure shift or a clear change of character. Either way, it becomes your first layer of confirmation. What this market structure shift tells you is that the temporary bearish move is likely coming to an end, and that bullish momentum may be returning. At this point, price is expected to align again with the higher time frame trend. Once that bullish structure is confirmed and we expect price to continue higher, the next step is to look for a buying opportunity. At this stage, you need an entry model to form. For the first entry, I usually look for a bullish breaker block forming inside the higher time frame supply or demand zone. For a valid bullish breaker block, price should first form a swing low, then a swing high, followed by a lower low. After that, you want to see a strong expansion move to the upside that breaks structure and confirms the shift. In this situation, the up-close candle, or group of up-close candles, formed between the first swing low and the swing high becomes your breaker block zone. That is the area where you plan your long entry. Everything here should be marked manually on the chart, step by step, exactly as shown earlier. From there, the next step is to place a buy limit order at the highest point of that breaker block and wait for price to retrace back into the zone. For your take profit, you can target the nearest liquidity on the current time frame or aim for a key level on the higher time frame if you are expecting a larger move. In situations where price has already moved in your expected direction, respected the demand zone, and your first position is already in profit, you can also look for a continuation entry when a new break of structure forms. This typically happens when price creates a new bullish fair value gap during the expansion leg of the new break of structure. In that case, the next unmitigated bullish fair value gap becomes your second entry zone. From there, place a buy limit order at the highest point of that fair value gap, with the stop loss positioned a few pips below the most recent swing low. On the bearish side, the same logic applies, just in the opposite direction. The previous strategy used supply and demand zones together with market structure shifts and breaker blocks to confirm entries. However, there are situations where traders prefer to focus on a different type of confirmation. Instead of waiting for a breaker block, this next model combines higher time frame changes of character with fair value gaps and inverse fair value gaps to identify potential reversals and continuation opportunities. This model also requires working with two time frames. Begin with a higher time frame, such as the 4-hour or 1-hour chart, to analyze the market structure and identify a clear higher time frame change of character, together with an unmitigated fair value gap connected to it. After that, move down to a lower time frame, such as the 15-minute or 5-minute chart, depending on your preference, to look for reversal signals, confirmation, and eventually a proper entry model. Now let's go step by step and break down exactly how to apply this on the chart. The first step is to analyze the higher time frame structure and determine whether price is in a strong uptrend or a strong downtrend. In a bullish scenario, start by identifying a strong downtrend. To confirm that downtrend, price should form at least 3 consecutive bearish breaks of structure. On the other hand, to confirm a strong uptrend, price needs to form 3 consecutive bullish breaks of structure. Once that is clearly marked manually on the chart, the next step is to look for a higher time frame change of character. When price breaks and closes above the most recent break of structure high of a strong downtrend, that signals a bullish change of character. This suggests that sellers are losing control and that the market may be preparing to shift direction. Once this shift in structure is confirmed, and we expect price to move higher, the next step is to look for a buying opportunity. At this stage, focus on identifying a bullish fair value gap that forms within the change of character leg. After marking the higher time frame change of character and its fair value gap manually on the chart, move down to the lower time frame and wait for price to return to that higher time frame fair value gap. Once price enters the zone, closely observe the price action inside the gap and look for signs of rejection. That reaction confirms that price is respecting the higher time frame imbalance and gives you your first layer of confirmation. From there, the next step is to identify a violated fair value gap that turns into an inverse fair value gap, either inside the higher time frame fair value gap or just outside it after the rejection. This becomes your second layer of confirmation. When this inverse fair value gap forms, it often acts as a new support level, and this is where you begin planning your long position. At this point, the focus shifts to execution. To enter the trade, you have 2 options. The first option is to enter immediately after the inverse fair value gap forms inside the higher time frame fair value gap. In that case, you open the position at the opening of the next candle, with your stop loss placed below the most recent swing low. The second option is to place a buy limit order at the highest point of the newly formed inverse fair value gap and wait for price to retrace into the zone and trigger your position. For your target, you can aim for the nearest buy-side liquidity on the current time frame, or if you expect a larger move, you can target a key level on the higher time frame. It is also important to remember that you can always add extra confluence or confirmation factors to this setup to improve its win rate, depending on your trading style. For example, you might require price to fill at least 50% of the higher time frame fair value gap, or wait for additional confirmation signals such as an RSD formation before entering the trade. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.